Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of AleaGreen, and thank you for joining us today in this webinar with the topic Prospect for the energy markets in Europe, price forecasting and its importance for renewable energy development. Our first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft and Associate Partner of AleaGreen, that will analyze the evolution and prospects of the European energy markets, the importance of price forecasting in the renewable development, and that will show you the AleaApp platform we have developed. Then I will talk about AleaGreen, a new division of AleaSoft specialized in long-term price forecasting. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentation. And now, I hope you enjoyed the webinar. Oriol, please share your slides.
Good morning. Thank you, Alejandro. Good morning, everybody. As Alejandro mentioned, we will talk about electricity, energy markets. Also, we will be talking a lot about forecasting these energy markets. How are the prospects for the next quarter until the end of the year? You will see very interesting topics that will and events that will take place in the electricity markets, especially in the Iberian electricity markets. We will see online data. So let's begin. As always, I will start briefly explaining what are the services that we are providing in case you don't know us. In AleaSoft, we offer forecasting services for the energy sector, covering all the energy markets in Europe. Our forecasts go since the short term, so day ahead market, hours ahead, up to long-term reports that can go up to 3 decades ahead. We obviously forecast demand and price for the energy markets, gas, electricity, etc., but also any other variable that is interesting for the sector, obviously renewable energy production, weather conditions, socioeconomic indexes, CO2 prices, oil prices, fuel prices, and not only spot markets or day-ahead markets, but also ancillary services, so markets like imbalanced markets, technical restrictions, etc. The methodology that we use to forecast is the ALEA methodology. It's our own methodology developed specifically for forecasting for the energy sector. The 3 main points that we always like to stress about our methodology it's that it's a completely scientifically based methodology. It's a hybrid technology that combines techniques, more classical techniques like econometric models, regressions, time series analysis, combined with more advanced model techniques like from the artificial intelligence, like machine learning algorithms, recurrent neural networks, etc. This scientific based technology gives consistent results that keep coherence over time, and it's the methodology, the technology that we have been using now for more than 22 years for forecasting the European energy markets, starting in the Iberian electricity markets, now covering all the markets in Europe. And let's begin with let's see how the fuels prices and CO2 prices has been in the recent weeks. As always, I like to start with this historical perspective of the Brent oil prices. Oil prices are kind of a global index to know how the global economy is going. And recently, just after the beginning of the war in Ukraine, we had the highest prices that were close to the highest historical prices that we had in 2008, just before the financial crisis. But since then, in the recent weeks, prices has been down a little bit. So focusing on these last weeks, we had our last webinar just 3 weeks ago. So since then, since the higher prices that we had just at the beginning of March, then prices has been going down. So peak prices has been lower and lower. And since the mid-March, just before April, prices has been relatively stable inside this this general volatile and uncertain situation that we are right now. They have been more or less stable around this range, $100, $110 per barrel. Looking at gas prices, situation is a little bit similar. We had the highest prices just on March 8th or March 7th, just after the beginning of the war. And since then, prices have been relatively stable. Maybe we can start to see some downward trend, but still very volatile situation. We can see easily prices going up by 5–10% within one day. So very unstable, very volatile situation, but we can start seeing some slight downwards trend, let's say. I'm not very optimistic about that, but maybe we can start to see some prices very slowly going back to previous levels. On the other hand, we have the CO2 emission prices, where at the beginning of the war, we basically saw a huge drop in prices, basically by 40% within a couple of days. Basically, all the speculative inversions that were in this market at the beginning of the war, there were kind of an important fear about how how the CO2 prices and general economy would react to that, to the beginning of the war. So basically, there was a huge withdrawal of money from this market, and then it recovered slightly up to the 80 euros per ton, and it was very stable for several weeks at this level. And just before, or just the day that we made our last webinar, prices start increasing again, gaining volatility and starting what could be the resuming their previous upward trend that they had before this crisis. Let's see, again, very volatile and unstable situation, so it's difficult to see, but we can start to see some hints of how the things will be evolving. Now moving to the electricity markets, that basically they are reacting to the gas prices and the CO2 prices. And what we have seen in April, after having the highest prices for most of the markets during March, just after the beginning of the war, now, as we have seen in the prices of oil and gas, we have seen how in April prices have been slowly going down. On average, 29% of the a retreat from prices in March, but basically they go from the highest drop was in the German market, 34%, down to Italy, 20%. And then Poland, that is the one that did not reach the highest prices in March. They did in December last year. So now in April, they went down just by 12%. Looking at the last days, these are the daily prices for some of the most important markets, electricity markets in Europe. Basically, this is since the beginning of March, highest prices in history for most of the markets in March 8th, and this in Spain we reached nearly 700 euros in hourly prices, 500 in average daily prices. Since then, what we are seeing is, or we can start to see, if it's a little downward trend going in more or less all the markets. Again, a lot of volatility, prices at very high levels, around 200 euros per, or above 200 euros megawatt hour. These are prices well above the prices, the level of the prices that we had before the crisis. Before the COVID crisis, prices used to be around 40, 50, 60 euros megawatt hour. Right now, we have 3-4 times that prices. But again, following the gas prices, we can start to see some kind of slightly downward trend. And as I mentioned, there are some very interesting events happening very soon in the electricity markets. One of the most relevant, or most surely that will have an important impact, is what it's been called the Iberian exceptionality. That's how the Spanish and Portuguese governments made or get the European Commission to agree on giving them, the Iberian electricity market, this exceptionality based on the fact that the Iberian Peninsula is a little bit like an energy island, so it's very loosely interconnected to the rest of the European markets. So based on that they have this, they are kind of isolated from the rest of the European markets. They get to this exceptionality to be able to reduce the prices in the electricity market in a very, let's say, in a very drastic way. So the idea is lower the electricity prices for the final customers, and they will do it by limiting the offers in the wholesale electricity markets, that the power plants that use gas to generate electricity, they will have their offers will be limited. And this limit, it's a little known about the details, because in theory it will be this rules will be approved tomorrow by the Spanish and the Portuguese governments, but then it needs again to have the final approval from the European Commission. So probably it won't start working at least until Monday, but probably it will be later in the next week. So very little is known until the final decree is not in place, but we know some details on what the European Commission has agreed to allow Spain and Portugal to do. It's limiting the offers, as I said, of the gas-fired power plants in the electricity markets at 40 euros per megawatt hour of gas. That's the limit on the gas prices. This temporary limitation will be in place only for 12 months, and the average cap on the gas prices will be 50 euros megawatt hour, but it will start being 40. So it will go from 40, then raising. So the average over the whole period is around 50 euros per megawatt hour. If we take these gas prices combined with CO2 prices of 85 euros per ton, that is more or less the level that we are right now, between 80 and 90. Final prices on electricity markets will be around 110, 150, depending on how the CO2 prices are doing. So effectively, prices on the Iberian electricity markets will be, for sure, for the next 12 months, lower than these levels. And how will the gas-fired power plants will be compensated? How they will be compensated? Because they will be offering below their cost. So these compensation, these overcosts from the gas plants will be paid by all the agents making purchase offers in the market. So according to the MIP gas prices, these are the Spanish gas market. According to these prices, they will the cost of the gas plants will be established, and then what is left, since this 110-150 euros per megawatt hour, until their cost will be assumed by the buyers of energy. So probably the final price for the consumers will be a little bit higher, but much less higher than having to pay all the full gas price to all the technology. We will be paying only to the gas technology. So what will happen? Well, obviously, for the next 12 months, we will have highly limited prices in the Iberian electricity markets. This will make Iberian prices more competitive than French prices in the French market. So we can expect that we will have, basically we will be exporting energy from Spain and Portugal to France and the rest of the markets, basically full-time 24/7. So we will see our need for production for electricity generation increased. So probably this extra production will be filled with gas from gas plants, because usually renewable energy and hydroelectric generation is not enough to cover all the demand plus all the exports necessity. So we will be increasing electricity generation with gas. This will increase the level of emissions. And then there is the fact that we will be changing the rules of the market just in the middle of the match. So this will bring obviously regulatory uncertainty. This will increase the fear of future investments. It will affect the current PPA negotiations and future negotiations. So we will see how financing of new renewable projects will be affected by these new decisions. And just one consequence that we are already seeing is in the futures market. So obviously, futures market are trying to cover, to hedge the prices into the future. So here you have the evolution of the future prices in the OMIP futures market for Spain, June, third quarter, fourth quarter, the first quarter of 2023, and then Cal 23 and Cal 24. Basically, you see that each of it has its own level, and just the day that it was announced that the European Commission said that they agreed with this Iberian exceptionality, it was April 26th, and just that day, all the prices for all the futures collapsed to the same level, around the expected level of prices, 150. That's more or less the expected prices that we'll have. And since then, they basically are evolving all together. So basically, we are already assuming that we will have basically fixed prices most of the time for the next 12 months. And well, Cal 24, that in principle it's not affected, but because 12 months from now, this rule will be in place more or less until April, May next year. So Cal 24 wasn't affected at all. So futures for that year basically remained unnoticed about this future change. So let's see now about forecasting, about energy forecasting. How useful, how can we use, how is used this all this information that forecasting all these markets that we have been seeing is useful. So basically, as I mentioned, we are in AleaSoft, we offer forecasting services. So basically, based on based on the experience of our customers, we along the years we have been analyzing and understanding how this energy forecasting has been using and how are they useful for our customers and for all the players in the energy sectors in general. So let's see, and probably I will not cover all the possible uses of this forecasting. Probably there are some clients that are using in different ways, but this is more or less what we have been learning, what we have learned over all these more than 20 years that we have been playing this role in the in the energy market. So let's try and have a look. So one of the first, the first clients that we have 20 years ago, that's a long time ago, basically were control centers from TSOs, control centers from renewable. Well, at that time there were thermal plants, but basically we can think of control centers from renewable plants, for groups of renewable plants, for a combination of renewable and thermal plants from the same company. And basically, in order to operate the day-to-day in these control centers, basically you need to have forecasting at the short term, so hours ahead, so forecasting in real time, but also forecasting the day ahead and the following days, basically in order to be able to operate these all these plants. Obviously, you need if you are a TSO or a DSO, you need demand forecasting. Temperature forecasting can help you to understand the demand forecasting, wind energy, solar energy, hydroelectric energy. So all this is needed in order to operate your grid, your network, if you are a TSO or a DSO, or to operate the production or the offers that you are making into the market for your renewable projects, renewable power plants. As I said, and then obviously you need pricing forecast in order to optimize how you sell your energy or you offer your energy in the market. Not also day ahead market, but also, as I said, ancillary services. There are intraday markets. We are forecasting intraday market 1, intraday market 2. There are up to 7 options, and then there's the continuous market. Also ancillary service like the secondary reserve that we have in Spain, constrained markets also. This is for the short term, but in a control center, you also need midterm forecasting. Why you need midterm forecasting? So in order to, I was mentioning that in the previous slide here, in order to, if you have to plan ahead, obviously if you are a TSO, you have to plan months ahead in order to have your grid ready for the demand that will be in the future, months ahead, years ahead. But if you are operating a power plant, if you need to do some maintenance work that need producing the power or shutting down the whole plant, in order to optimize when will be the best moment into the future to make that maintenance, is always interesting to see, to have a vision of what will be the prices, what will be the demand, what will be the generation at that point, in order to, let's say, minimize the cost or minimize the losses that you can have while doing this maintenance, this upgrade, everything that has to do with the typical operation of a power plant. And very similar to that is the role that energy forecasting has for the smart grid. So we know into the future, as the renewable capacity increases, electricity demand increases, Renewable energy production will be it's intermittent, it's volatile. So we need that demand will try to be more flexible in order to respond to the price signals into the future. So we know that these smart grids, so these grids that will be able to balance at every time production from renewable power plants, from self-consumption, rooftop photovoltaic installations. So all this has to be monitored and forecasted in real time in order to be able to balance, to always balance demand and production at any given time in the moment. So real-time forecasting for smart grids will be will be necessary, obviously, and the smart grids will be necessary into the future when we will be producing most of or all the energy with renewable energy sources, with green hydrogen, with storage energy. So crucial point, electricity forecasting for for the smart grids into the future. And for the for the financing of the new renewable energy projects, well, financing is it's a key element in this energy transition. We know in Spain, it has been estimated that we will need up to 100,000 million euros, or 100 billion in English, 100 billion euros in order to build all the necessary renewable capacity in order to meet the climate target that we have in 2030 and 2050. So financing will be necessary and will be a key point. And we know that PPAs and renewable energy auctions are not completely necessary, but are very important in order to get financing for your project. So, and when you are negotiating a PPA, when you are designing the offer that you're going to make in a energy public auction, you will need to have a vision of the future. How will the market will be in the future? How will the prices will be in the future? And in order to do that, you need long-term energy price forecasting to get this view. So here you can see one of the long-term price forecasting that we did for the Iberian market back in 2010. And you see that what is important in long-term forecasting, obviously, is not to get the price of every month basically exactly correct, because we know it's impossible. We know that prices fluctuate and the prices will keep fluctuating into the future. So what is important is to get right the level, the trend, the time structure, and then define or estimate what will be the fluctuation of these prices. So you will always have this kind of upper and lower bands that will tell you it's very improbable prices going above this level or below this level, and this and these confidence bands we also have a probability associated with them. So usually we provide 85% and 15% percentiles for these bands, sometimes 25, 75, but basically they are giving you an input, a value that gives you exact probability of prices going above a certain limit or below a certain limit for any time in the future. So this is basically what you need in order to as an input for your financing model, for your risk management. So basically they are not alternative scenarios where basically so we are not combining different scenarios of our variables in order to get this these bands. We are simulating all the possible scenarios into the future and then defining a probability. So this is basically, we are not trying to we are not trying to depict what will be exactly the situation into the future, because we don't know what will be the scenario, but we are simulating all the possible scenarios with each probability associated. Then we are getting this distribution around our central probability. That's key. That's very important in order when you are trying to have a clear vision of the future of the energy markets. And then it's not just important to have the annual average or the monthly average of the price, but it's important to have also hourly pricing forecasting. So knowing the price or the average price for each hour into the future, it's very important, for instance, to estimate the capture price of your installation. So knowing that you have a solar power plant with a given production profile, then you can estimate using the hourly price forecasted what will be the estimated capture price, because one thing is the average market price and the price that your another thing it's the price that your plant will receive, and that's important to have this understand this. Very important also into the future, energy storage, hybridization of different technologies, and production technology, renewable production technology with storage technologies. In this case, also very important to have hourly price forecasting in order to estimate correctly how we will be using into the future our storage capacity and our and selling our energy to the market. So important when you are designing in order to correctly estimate what will be the revenues using the optimal way your production and your storage capacity, and also important when you are operating a plant. So in short term, you need short-term price forecasting in order to maximize in each hour and each auction how will you sell, how will you use the energy that you are producing. Energy trading is also one of the most of our, or a lot of our clients are trading energy. In this case, it's important in order to have midterm forecasting in order to optimize your hedging in the futures market. In this case, we are also offering probabilistic forecasting. So you will have probabilistic values in order to manage your risk probably. So if you have a risk model, having all these inputs is key. Having numerical inputs is key for assessing your risk. Having these scientifically numerical values for the prediction will make you able to calculate, for instance, your value at risk. What is the amount of energy that I need to pay with a confidence of 95%, 99%. So all this is can be computed thanks to having probabilistic midterm price forecasting. And then we have the large energy consumers. So and in this case, it's just like producing energy, but from the other side, buying energy. So basically, you need the same tools. You need obviously short-term forecasting in order to buy your energy into the daily market. If you are a large consumer, you have the ability to go directly to the market. You don't need a retail company to buy the energy. You can buy it directly to the market, to the spot market. Midterm forecasting, sorry, for in order to buy and sell energy into the futures market, and long-term forecasting if you are evaluating or if you are thinking on, for instance, signing a PPA. And then apart from energy forecasting, what is very important for forecasting for the energy sector, and nowadays we know that having updated and quality data is key for any analysis that you want to do in any business, but particularly in the energy sector. So having data, it's important for analysts, investors, journalists. We always see a lot of news about records in renewable energy production, records in prices. So all these analyses need need data. CEOs, our own CEO, Antonio Delgado, is always looking at the data and pointing us to some interesting events, some interesting analysis that can be done. And we will now see online how our online platform for data looks like. And I will switch now to the online platform. So you'll be able to see, and we will be looking at some interesting things that I haven't time to to go for. I didn't have time to go through all the electricity market, but we will be seeing some interesting events. For instance, well, the data in our platform is grouped in what we call observatories. Basically, they are electricity markets, Spain, Portugal, France, etc. And then we have fuels, futures markets, etc. So for Spain, for instance, we can see this. We have all the most interesting variables, so prices, demand, productions, etc. For instance, this is the prices, and since we go back to the January, the beginning of the year, we can see how we had the highest prices during March 8th. We can change the granularity. This is the daily average, and we can go back a little bit more, back to 2020, see the last years. And we see how in 2020 we had, during the worst part of the pandemic crisis, we had the lowest prices that we had in, and then how rapidly in several months we get the highest prices. We can change to the monthly average and see how fast we went from prices of less than 20 to more than 250. So crazy. Well, you have available all the history of the market, so you can go back until 1998. That's the very first day that the market started, Spanish market. So you can see how the prices that we had in the last month are really exceptional. The yearly average, you can see how 2021 it's been the highest year in the history, and how 2022 will be the highest for sure again. Demand, for instance, this is the hourly demand of the last weeks. You have the ability to compare to weeks. For instance, this is the current week, but we can compare with the previous week, with the previous week, from the previous week. And if you go back 5 weeks, you can see how in the 5 weeks ago we were in the Easter. It was Holy Week, so we can see how Thursday, Friday, they were holidays in Spain. Obviously, it has an effect in the the electricity demand. We can go back to series. We can look at the daily. That's the daily average. We can also have the daily total. And for instance, if we go back to the beginning of the year, we will be able to see how the demand is reducing because weather conditions are getting warmer, and we know how demand responds to temperature. Again, this is the daily total. We obviously see how the strong weekly pattern that the demand have, but we can filter for a moving average of 7 days, and we have a clear trend removing this weekly effect. And then we have the ability, well, we have solar production, wind production, well, all the interesting info. And then we have the ability in this multi-graph section to have the comparing different series, in also to have some kind of analysis power. So basically, I'm going to look at the price and the demand and the wind production I'll put in a second in the axis. So basically here we can see how prices respond to, let's go back to the beginning of April, how prices that are the blue line respond basically to the demand. Demand is an important driver for the price, but also how these down peaks for the for the electricity prices match exactly the peaks that we have in the wind production. That is this yellow line. So you can see how they are basically anti-correlated. So high wind energy production leads to lower electricity prices. And also we can see, for instance, the effect on the demand and the and temperature, for instance. And it easily see, as I mentioned, for instance, going to the beginning of the year, how as when we have very low temperatures, we have higher demand, lower temperatures, higher demand, and the other way around, higher temperatures, lower demand. So as temperature is increasing, low electricity demand is getting lower. Well, as I mentioned, we also have other markets, France, for instance. Now, my computer is always struggling when streaming and looking at the observatories at the same time. Fuels prices, for instance, we can see the TTF, gas, coal. Within time to have a look at the coal. We can compare, for instance, TTF prices, that is the Dutch hub, prices, gas prices in Spain, and seeing how they are basically usually having a similar behavior. But since the beginning of the crisis, as Spain has a lot more of regasification power, so relying less on pipeline gas. So basically in Spain and European prices are separating a little bit. We also have futures, and we can compare, for instance, how the impact on the impact on the futures, comparing France and France and Spanish futures. And as I mentioned, how starting on April 26, just when the European Commission gave the okay to the Iberian exceptionality, prices, future prices in Spain start going much lower. And okay, well, I just mentioned that you have also the opportunity to group the variables that you like in a given observatory. I have these EU prices where I have only the prices of all the interesting markets, and ES prices where I combine gas prices and Spanish electricity markets, because are the ones that are useful for me to do kind of analysis. Okay, going back to the slides, in our website you can also see all the other reports that we are basically providing, analyzing the energy markets. Now, looking a little bit into the future, these are the forward curves in the futures market. So basically comparing 3 weeks ago when we made our last webinar, basically no changes in the forward curve of the Brent oil, no changes on the forward curve of gas prices, and basically no changes in the short term of CO2 prices. But as we have been seeing several, we have been several webinars already seeing this effect. So the curve, or the forward curve for the CO2 prices, is getting steeper. So basically we have no changes at the short term, but we are seeing an higher increase in the long term. So again, the CO2 curve is getting steeper, and it's been several months already with this curve getting steeper and steeper. Power prices forward curves. So these are the forward curves for the electricity markets: Italy, Spain, France, and Germany. Italy Italy, France, and Germany at very high levels in the short term, responding to higher spot prices, but also at the long term. So right now these are calendar years. So we are talking about 150 euros megawatt hour for the whole year. So really, really very high prices. Although these prices are synthetic prices because there is no liquidity in the markets at such a long term. As always, the Spanish forward curve very different. Let me remind you again, a warning for not using these forward curves as a forecast of the future spot prices, because as you can see, there is no reason into the future to have such different prices in these markets. And just as summarizing, what are the key elements that we are taking into account right now when forecasting energy prices? So as we have seen, prices relatively stable within this huge uncertainty and instability situation that we are right now. CO2 prices seem that they can regain this the upwards path that we had in the past. Probably we will keep an eye on it, trying to see. Electricity markets, as gas prices and oil prices, seem to have a slightly downward trend, but we don't expect major price drops, at least until after the next winter. So no changes in this sense. Let's see how this price cap in the electricity Iberian electricity markets will affect Iberian electricity markets, of course, but also prices on other markets, because as we have shown, exports to the rest of the markets will increase due to this limitation. And at the longer term, well, the European Union is trying to be as energy independent as possible, as soon as possible. They are trying to accelerate this energy transition. So we will see how this will impact on the future scenarios that we have for hydrogen, renewable energy capacity, storage capacity, etc. And just before finishing, let me invite you to our next webinar. It will be with Engie again. It's been already several occasions that we have joined Engie in our webinars. Always very interesting. They always have very clear insights of what's within the PPA markets. Of course, they have firsthand a lot of PPA information. So always very interesting and very useful listening to Engie. We'll be talking about obviously PPAs, financing, and we will be looking at the markets for the second half of 2022. And that's it, Alejandro. Now it's your turn.
Thank you very much, Oriol. Great presentation as always. And I will share my slides now to introduce AleaGreen. So as mentioned before, AleaGreen is a new division of AleaSoft created at the beginning of this year, and it is in charge of all of the long-term price forecasting developments that we do for European markets. With the several PPAs that have been signing throughout Europe in the past years, the long-term price forecasting reports that we offer are the most demanded product that we have right now, and we have delivered more than 300 reports over the past 3 years, mostly for renewable developers, but also for off-takers, big consumers of electricity or electro-intensive companies that are looking for green energy, and also for banks and investment funds that are looking to finance these renewable projects. We have provided long-term reports for all of the markets highlighted in this map, but we have more experience in some markets than others, depending from the needs of our clients. For instance, we have provided the most reports for Spain because it's where the most PPAs have been signed in the past years, but also we have been requested a lot for Italy, Poland, Romania, also France, Germany, UK, and the Nord Pool markets of the Nordic and Baltic countries. So AleaGreen was created to answer any needs of the energy sector for long-term price forecasting. Our long-term reports have been used as reference for bilateral contracts and PPAs, as Oriol mentioned, in financial models for renewable development, also to estimate revenues from hybrid plant and batteries, and energy storage studies, and for analysis of investments or MIA, and for asset evaluation and due diligence. The long-term report we provide consists in two documents: an Excel file with the forecast, the annual scenarios of the main explanatory variables, the historical data of the latest years, and a PDF document with a description of the methodology, the scenarios, the assumptions made, as well as an analysis of the results. And these results are price forecast with hourly granularity, covering the 30-year horizon, an annual confidence band corresponding to percentage 15 and 85, as Oriol showed, where you can see the probability of price fluctuation in the future, and the annual capture price by the solar photovoltaic and wind energy production. So last, I wanted to show this graph again because it shows the quality of AleaSoft long-term price forecasting methodology. As mentioned by Oriol before, this is a retrospective forecast that we made in 2010 for the Spanish market MIBEL. At the time of doing the forecast, as you can see, the price was a little chaotic and you might say unpredictable. But our forecasting model managed to capture the essence in all this chaos and obtain an equilibrium point, which is the mean forecast provided, as well as the confidence bands obtained through the simulations that sets the limits where the price should stay in order for investments to remain profitable, for instance, or the prices that the consumers are willing to pay for the electricity. As you can see, the real price has been following this equilibrium point, oscillating around it. And yes, at some points, the confidence bands have been surpassed, but this is the meaning of the confidence band. It has a probability of being surpassed, and you can see how the price always returns to the equilibrium point, and the forecast remained valid for most of its horizon up to the global pandemic with the fall of prices. But even if right now we are in a new energetic crisis with the really high prices obtained throughout Europe, as this graph shows, there is a market equilibrium, and at some point, we expect in the next years, the prices will have to go back to this market equilibrium. So thank you, that was AleaGreen for you, and we will start now the Q&A section of this webinar. And Oriol, I believe you already have a question selected. You can start.
Yes, yeah, I can start. There are a couple of questions about the price cap on the Iberian electricity markets. I'm sorry, but I will not be able to answer all of them because, as I said, there's very little known. There's basically nothing official. So we will not know until the Royal Decree Law is in place, and it will be probably on Saturday. So, but for instance, how since the prices are going to be limited, will the minoration will be applicable on top? So we know there is already a minoration on the income from renewable plants. So how will this be compatible with this price cap? We don't know. How gas-fired power plants will see any profits if they will be compensated only up to the real production cost? We don't know. We don't know how will this compensation be calculated. Probably, or well, at least it's obvious that it will have a given margin in order to obtain profits. If not, that it will make no sense. But as I said, there is very little information available. We don't know yet. Probably next webinar we will be always able to answer all these questions.
Okay, so I will answer the next one. The question is, how often do you update your long-term price forecast? Well, right now, the long-term price forecasting reports that we provide you can obtain them in two ways. It can be a one-time only delivery. Whenever you need the forecast, we update it and send you the report, or it can be an annual subscription with 2 or 4 deliveries per year. So this means that we are updating our European reports for most of the European markets at the beginning of each quarter.
Okay, there's another question, very interesting question. Electricity price in Spain is a lot higher than in Poland. That's something that we have already seen. Yeah. So why PPA prices in Poland are 2 times higher than in Spain? That's very interesting, and this has to do with the expected spot prices. So right now it's a kind of an exceptional situation. Poland is based has its electricity generation based on coal mainly. Coal prices has been up a lot, but not such higher prices than gas. So in Spain and the rest of Europe, basically is the gas, that one that is setting the marginal price. So obviously we are having much higher prices, but PPAs as a long-term agreement are looking at the long term. So at the long term, we know in Spain we will have a lot of renewable energy production. So a lot of pressure, downwards pressure onto spot prices, and not just that, because there's also in PPAs there's also an equilibrium between offers, supply and demand. So in Spain, as we have in Spain, as there is a lot of solar resources, so a lot of irradiation, the part of the whole continent, the whole Europe with the most higher solar irradiation is the southern part of the Iberian Peninsula, even higher irradiation than in Greece or in Italy. So there are a lot of potential, a lot of renewable projects in the Iberian Peninsula. Then there is a lot of demand for off-takers for this energy. So there is a lot of production. So you obviously, if you want to get an off-taker, you have to offer lower prices. So a lot of supply, let's say, of PPAs means lower prices. In Poland, probably there are not for sure not so many solar projects. There will be for sure a lot of wind energy projects, mainly offshore, but obviously less supply of PPAs means higher prices.
Okay, I will sorry. I will answer the next one. It's regarding the AleaApp platform that Oriol shown, and it asks if we have prices for Hungary, because we didn't show it. And regarding the platform, we are at all times including new observatories, new European markets, and also new data on the observatories that we already have. And specifically for Hungary, we have all of the data for the market. We have many years of experience forecasting the different horizons for Hungary. So it's not a problem if you need the observatory for Hungary, we can include it.
Okay, I don't know if we have time for a last question.
Yeah, one more. Yeah.
Okay, one interesting question. How do anomalous situations such as the ones that we are experiencing affect a statistical model? That's a very interesting question. Our methodology is statistically based, so obviously input data is one of the main sources, one of the main inputs into the models. So it is very important how your data, how your variables describe all the events in the past in order to the model to interpret them or understand them correctly in order not to interfere with your projection into the future. So if you have an anomalous situation like the one that we are having right now, you have to have the correct variables that describe this situation, so your model, the artificial intelligence, will be able to understand why this situation is exceptional, and then take it into account in the proper way when you make the projection. So if it's extremely anomalous, we will try it not to interfere negatively into the future projection. So right now we have gas prices going up, CO2 prices going up and down, a lot of volatility. All these inputs are introduced in the model in order for it to understand how exceptional is the situation and how to treat it in order to not affect the forecasting into the future.
Okay, perfect. So we will answer the remaining questions directly by email. And thank you again, Oriol, for your presentation and the audience for joining. Have a nice day.
Goodbye.